Welcome to this second episode of the use of financial ratios for analyzing companies' performances or comparison of the company's performances. Use of financial ratios for the gaining insights into companies' performance variance over time periods and variance with the other companies. Verifying the method of decomposing the Dupont ratio analysis into micro-level ratios for insight. Here we'll concentrate on decomposing the net profit ratio of Dupont analysis into more micro-level ratios and examine the various methods of analyzing the factors that drive the variation in net profit ratio. The degree of operating leverage, how that explains variance in the profit over different time periods by examining the change in proportion of fixed overheads. How companies use degree of operating leverage for enhancing the net profit. Using standard cost ratios like sales value variance to explain the difference in sales value over two periods. Using standard cost ratios to explain the variance in COGS, that is cost of goods sold, is all cost loaded on production inventory. I'm Aninda Datta, the presenter. Now let's examine how to decompose higher level ratios into micro level ratios to get better insight into the company performance. Suppose a company's return on equity, that is net profit by equity capital, shows year-on-year decline. Then we need to pinpoint the exact cause for the decline. So let's decompose the debt equity ratio into three constituents ratios by multiplying both numerator and denominator by the sales revenue and by assets. The resulting equation could be written as follows, which is the Dupont equation. That is, the return on equity is equal to net profit margin into asset turnover into leverage ratio. That is the net profit by revenue into revenue by assets into assets by equity capital. This is one of the most widely used equations in the world of financial analysis, as it indicates the major areas in which which are driving the change in return on equity. These three ratios are calculated for both the financial years to figure out where the difference lies. Suppose this Dupont equation shows a major decline in net profit ratio, so we have identified one problem area, but we need to further decompose the net profit ratio to find out the exact driving factors for decline in net profit ratio. So we need more information about gross profit, COGS, interest cost, and tax expenses. Now let's examine how to decompose the net profit ratio into more micro-level ratios. Multiply both numerator and denominator of the net profit ratio by EBIT and EBIT for decomposing the net profit ratio. The equation could be restated as net profit by sales equal to net profit by earning before tax, that is EBIT, into EBIT by EBIT into earning before interest and tax by revenue, that is tax burden ratio, interest burden, and EBIT ratio. Now this is a sample income statement where sales revenue appears at the top, less COGS gives gross profit, less operating expense gives EBIT, earning before interest and tax, less interest expense gives earning before tax, less tax expense gives net profit. The comparison of these ratios will show period on period movements in operating expense, interest, and tax. So these are the places from where EBIT ratio, interest burden, and tax burden are calculated. If interest expense goes up, the interest burden ratio goes down. If tax expense goes up, then the tax burden ratio goes down. This is a table showing data sample of sales to net profit calculation. Here in the calculation, if we multiply the three constituent ratios, that is the EBIT ratio, interest burden, and tax burden, then we get to the net profit ratio of 15%. If we multiply these three, we get this 15%. Now let's examine how the difference in structure of COGS and other operating expense could drive change in the gross profit. The overhead part of COGS and other operating costs are a combination of variable and fixed costs. So any change in the ratio could change the operating profit on change in sales revenue. The term operating leverage is widely used in financial management to measure the degree to which a firm's operating profit changes due to change in sales revenue. Now sales minus variable cost equal to contribution minus fixed cost equal to operating profit. The degree of operating leverage is given by the formula contribution margin by net operating profit. The degree of operating profit is like a multiplier. Suppose the multiplier is 3, then that means if the sales revenue increases by 10%, then the operating profit increases by 3 times, that is by 30%. If the fixed cost goes up, then the degree of operating leverage also goes up. If the variable cost goes up, then the degree of operating leverage goes down. Thus, if the degree of operating leverage changes from period to period, that is bound to change the earning before interest and tax ratio on change in sales. The company with increasing sales can increase operating income by increasing operating leverage. However, the operating risk also increases that way. The table shows calculation of degree of operating leverage in second column. The operating leverage in the second column is 2.33. So net operating income will increase by 2.3 times the percentage of hike in the sales revenue. The next column considers a revenue hike of 10%. So the net operating income shows a gain of 23%, that is from 15,000 to 18,500, which is exactly 23% gain. Now here with the same sales level, the variable cost is 50% of the sales. Fixed cost is higher by 15,000. Keeping the total cost same, that is the variable cost is reduced and the fixed cost is increased, thus increasing the operating leverage to 3.3 times. Now when we increase the sales by 10%, the net income increases by 33%, that is from 15,000 to 20,000. Thus, a company with rising sales may increase operating profit by opting for higher proportion of fixed cost. That is by having higher operating leverage, but it also enhances the level of operational risk. However, as it is leveraged, so works in both directions. In case of decline in sales, the reduction in profit will be higher or may turn into operational loss. Net realizable selling price and sales volume are also major drivers of the net profits. The traditional sales value variance was used for standard costing purpose, but the same could be extended to the period-on-period comparison also, with standards being used as previous period's numbers and actual being the current period's numbers as shown below. Sales value variance equal to current period sales value minus previous period sales value. The positive sales value variance increases the net profit, whereas negative sales value variance has a negative effect on the net profit. The sales value variance could be decomposed into sales volume variance and sales price variance. The sales value variance is equal to price 0 into quantity 1 minus quantity 0 plus quantity 1 into price 1 minus price 0. The first one being sales volume variance and the second one being sales price variance. The COGS variance between the two different periods too could be analyzed using the standard costing methods. A COGS comprises material cost and production overheads loaded on the inventory cost. So variance analysis is done separately. Material cost variance analysis comprises price variance and quantity variance. Material price variance is equal to price 1 into quantity 1 minus price 0 into quantity 1. 1 is the current period and 0 is the previous period. Material quantity variance equal to quantity 1 into price 0 minus quantity 0 into price 0. 1 is the current period, 0 is the previous period. Material cost variance equal to material price variance into material quantity variance. The company is following standard cost method of inventory valuation loads production overhead cost on the inventory to arrive at the standard cost. The difference between standard overhead loading on actual production and actual overhead cost is present as over/under absorption of production overhead in manufacturing overhead variance account. Thus, total overhead variance equal to difference in overhead variance account between the two periods plus difference in total overhead loading on the actual production. We examined various aspects of financial ratio analysis pertaining to net profit ratio in this presentation. The return on equity was decomposed into 3 different ratios, and the various methods of examining the differences in net profit ratios were explored. The traditional standard cost methods could be used for comparison of financial performance between the different periods and different companies and for internal budgeting purpose by a company. The ratios used are not watertight, and new ratios or combination of ratios could always be used based on needs to analyze the specific areas. Degree of operating leverage is a kind of ratio analysis that could be used for detecting the factors driving the difference in overhead cost and for planning the future structure of overhead costs based on the future revenue projections. The methods of decomposing the other 2 ratios of DuPont analysis, that is asset turnover and the leverage factor, would be covered in a separate video. So this concludes this presentation. Thanks for watching. I'll soon come up with the next episode on this financial ratio analysis.